Investing in the stock market can feel like riding a roller coaster. There are thrilling highs and stomach-churning lows. This constant up and down movement is called market volatility. Understanding volatility is crucial for every investor, especially in today's uncertain world. Market volatility can be influenced by a myriad of factors. Economic data, geopolitical events, and even investor sentiment can all play a role. When the market is volatile, it's easy to make impulsive decisions. Fear and greed can cloud our judgment, leading to costly mistakes. That's why it's essential to have a plan. A well-defined investment strategy acts as your roadmap, guiding you through turbulent times. It helps you stay focused on your long-term goals and avoid making rash decisions based on short-term market fluctuations. By acknowledging the inevitability of volatility and equipping yourself with the right tools and knowledge, you can navigate the markets with confidence. Remember, investing is a marathon, not a sprint. Staying calm and sticking to your plan is key to achieving your financial goals. Remember the COVID-19 pandemic? The markets sure do. The Nifty 50, India's benchmark index, experienced a dramatic plunge. It was a stark reminder of how quickly things can change in the financial world. On March 23, 2020, the Nifty 50 hit a low of 7,610.20. That's a significant drop from its pre-pandemic high. Many investors panicked, selling their holdings at a loss. Fear and uncertainty gripped the markets. But here's the thing about market downturns. They are opportunities in disguise. Savvy investors know that what goes down must come up. They use these dips to buy quality stocks at discounted prices. The key is to stay calm. Don't let emotions dictate your investment decisions. Instead, stick to your plan and focus on the long term. Remember, market corrections are a natural part of the economic cycle. Imagine putting all your money into a single stock. What happens if that company faces unexpected challenges? Your entire investment could be at risk. That's where diversification comes in. Diversification is like having a safety net for your portfolio. It means spreading your investments across different asset classes, sectors, and geographies. Think of it as not putting all your eggs in one basket. Let's look at the Nifty 50. Investing solely in banking stocks could backfire if the financial sector experiences a downturn. But by diversifying across sectors like IT, energy, and consumer goods, you reduce your exposure to risk. Diversification helps to mitigate losses. If one investment performs poorly, others can cushion the blow. This balanced approach leads to more consistent returns over time. Remember, diversification is your best defense against unexpected market events. Technical analysis is like reading the tea leaves of the market. It involves studying historical price charts and trading volumes to identify patterns and trends. Think of it as analyzing the market's pulse. Moving averages are a popular tool in technical analysis. They smooth out price fluctuations, making it easier to spot trends. A rising moving average suggests an uptrend, while a falling one indicates a downtrend. Another useful indicator is the Relative Strength Index, or RSI. The RSI measures the strength of price movements, helping to identify overbought or oversold conditions. An RSI above 70 suggests an overbought market, while one below 30 indicates an oversold market. For example, let's look at Infosys. If its price is consistently trading above its 200-day moving average, it signals bullish momentum. On the other hand, if Reliance Industries' RSI is consistently above 70, it might be a good time to consider taking some profits. Section 5. Beyond the charts. The importance of fundamental analysis. While technical analysis focuses on price movements, fundamental analysis delves into the intrinsic value of a company. It involves examining financial statements, industry trends, and management quality. Key metrics in fundamental analysis include earnings per share, or EPS, price to earnings ratio, also known as PE ratio, and debt to equity ratio. These metrics provide insights into a company's profitability, valuation, and financial health. Let's compare Infosys and Reliance Industries. Infosys, a leading IT company, consistently delivers strong earnings growth and has a healthy balance sheet. Reliance Industries, an energy giant, is undergoing a transformation with investments in renewable energy and telecom. By analyzing their financial statements, we can assess their long-term growth prospects and determine if their current stock prices are justified. Fundamental analysis helps you separate the wheat from the chaff, identifying companies with strong underlying fundamentals. Section 6. Playing it safe. Hedging your bets against market downturns. Hedging is like buying insurance for your portfolio. It involves taking positions that offset potential losses in your investments. Think of it as a safety net for unexpected market events. One way to hedge is by buying put options. A put option gives you the right, but not the obligation, to sell a stock at a specific price, called the strike price, within a specific time frame. If the stock price falls below the strike price, your put option gains value, offsetting losses in your stock holdings. For example, if you own Nifty 50 stocks and are concerned about a market correction, you could buy put options on those stocks. If the market falls, your put options will increase in value, helping to protect your portfolio. Hedging comes at a cost, just like insurance premiums. But it provides peace of mind, knowing that you have a plan in place to mitigate potential losses. Remember, hedging is not about making money. It's about protecting what you've earned. Section 7. HDFC Bank, a real-world example of combining fundamental and technical analysis. Let's bring it all together with a real-world example. HDFC Bank. HDFC Bank is a leading private sector bank in India with a strong track record of growth and profitability. From a fundamental perspective, HDFC Bank consistently delivers strong earnings growth and maintains a healthy balance sheet. Its return on equity and net interest margins are among the best in the industry. These factors suggest that HDFC Bank is a fundamentally sound company. Now, let's look at the technical picture. HDFC Bank's stock price is currently trading above its 200-day moving average, indicating bullish momentum. The RSI is hovering around 60, suggesting that the stock is neither overbought nor oversold. By combining both fundamental and technical analysis, we can conclude that HDFC Bank is a fundamentally strong company with positive technical momentum. This makes it an attractive investment opportunity for long-term investors. Section 8. Mastering the market, combining strategies for success. Investing is not a one-size-fits-all endeavor. It requires a multifaceted approach that combines different strategies to navigate the complexities of the market. By understanding and implementing the concepts of diversification, technical analysis, fundamental analysis, and hedging, you can create a robust investment strategy tailored to your individual goals and risk tolerance. Diversification ensures that your portfolio is not overly reliant on any single investment. Technical analysis helps you identify trends and potential entry and exit points. Fundamental analysis allows you to assess the intrinsic value of companies and make informed investment decisions. Hedging provides a safety net, protecting your portfolio from unexpected market downturns. Remember, investing is a continuous learning process. Stay informed, adapt to changing market conditions, and never stop seeking knowledge. Section 9. Your portfolio, your power, taking control of your financial future. Investing is not just about making money, it's about taking control of your financial future. It's about building a secure foundation for yourself and your loved ones. By understanding the principles of investing and implementing the strategies discussed, you can grow your wealth over time and achieve your financial goals. Whether it's retiring comfortably, funding your children's education, or pursuing your passions, investing empowers you to live life on your own terms. Remember, the power to shape your financial destiny lies within your hands. Take charge of your investments, make informed decisions, and watch your wealth grow. Section 10. The journey to financial freedom. Embracing the ups and downs. Investing is a journey, not a destination. There will be ups and downs along the way. Market volatility is inevitable. But by embracing the principles of diversification, technical analysis, fundamental analysis, and hedging, you can navigate the market's twists and turns with confidence. Remember, investing is a marathon, not a sprint. Stay focused on your long-term goals, stay disciplined, and never stop learning. The journey to financial freedom is within your reach. Take the first step today.